Chapter 12, Financial Statement Analysis. Part A is the only part we'll be covering in this chapter. Comparison of financial accounting information. We use ratios to make comparisons every day. We can also use ratios to help evaluate a firm's performance and financial position. Is net income of $10 million a cause for shareholders to celebrate? Probably not if the shareholders' equity is $1 billion, because $10 million is only a 1% return on equity. But if the shareholders' equity is $20 million, then a net income of $10 million is a 50% return on equity and definitely something to celebrate. Ratios are most useful when compared to a standard. The standard of comparison may be the performance of another company, last year's performance to the same company, or average performance of the companies in same industry. So as you see in this illustration, there are three types of comparisons. We could compare Under Armour to Nike, so we have a comparison between companies. We could have a comparison of Under Armour in 2017 to 2016 to see how earnings have done over time. Or we could compare Under Armour to the sports apparel industry average to see how they're doing compared to the industry. Part 1 discusses performing a vertical analysis. In performing a vertical analysis, we express each item in a financial statement as a percentage of the same base amount. For example, on the income statement, you will express each item as a percentage of sales. Sales will be your base amount. On the balance sheet, items will be expressed as a percentage of total assets. So here's an example of an income statement for Under Armour and Nike. We can take a look at these two companies and see that they're in the same industry, but there's a lot of differences in the two companies. Nike reports net income of $4.24 million, whereas Under Armour only has $257 million. Does that mean Nike's operations are more profitable than Under Armour's? Not necessarily. Nike is a much larger company. They have sales of over $34.35 million, whereas Under Armour is only at $4.825 million. To better compare the performance of these two companies, we need to use a vertical analysis to express each number as a percent of sales. So as you see, on the net sales, we have 100%. That's the base. That's what we're going to be expressing everything as a percentage of. So for cost of goods sold for Under Armour, we take the 2,585 and divide it by our base of 4,825 to get a percent of 53.6%. You would do the same thing with Nike by taking 19,038 and divide it by 34,350 to get 55.4%. As you can see, Under Armour's gross profit is 46.4% and Nike's is 44.6%. This means Under Armour earns a slightly higher gross profit for each dollar of sales. If we go on down the line, we can see and express, and make sure that you're expressing anything that is negative as a negative percentage. On the balance sheet, we'll do the same thing, except we'll divide each balance sheet item by total assets. So for example, current assets as listed is $1,965. Our base is our total assets of $3,644. 1965 divided by 3,644 gives us 53.9%. Notice your total assets have the 100%. Also, when you're doing the liabilities side, you're using the same base because remember, assets equals liabilities plus stockholders' equity. So this will still be 100% down here, and each of these is expressed as a percentage of the same base of total assets.